1040 tax forms include a space for reporting prepaid taxes. For many taxpayers, this means reporting the taxes that were withheld from their paychecks by their employers. That total is reported on Form W-2 to the taxpayer at the end of the calendar year, and in many cases, this withholding will be the total amount of taxes that have been paid to the IRS during the year. However, paychecks are not the only places where federal income tax withholding might be reported. Another common form for reporting income and possible withholding is Form 1099, which is also distributed to the taxpayer at the end of the calendar year. That form focuses on various income sources such as gambling winnings, dividends and distributions, certain government payments, and distributions from pensions, Social Security, and railroad retirement benefits. These 1099 forms indicate the amount of income from each source as well as the amount of tax withheld during the year. The amount of tax withheld, as indicated on the W-2 forms and the 1099 forms, is then transferred to the appropriate place on the 1040 tax form you're using for your client. Forms W-2 and 1099-R must be attached to the return when it is filed. Those are the only withholding forms that need to be attached to the tax return. There are types of income on which taxes are not withheld. If the taxpayer doesn't consider these tax ramifications, he could have a significant tax bill at the end of the year, plus penalties. To prevent this situation, the taxpayer can adjust his W-4 in order to decrease his withholding allowances, or he can require additional withholding be taken from his paycheck. If your client doesn't have an employer, or if he prefers to pay the taxes separately, he can make quarterly estimated tax payments using Form 1040-ES. For example, imagine that your client has a job and receives monthly alimony. You completed her return and reported that she owed $5,000 in taxes, which was alarming to her. In addition, there was the possibility of owing penalties because she owes more than $1,000. She does not want that to happen in the future. However, she projects the same amount of income in the coming year. She has two options. The first and the easiest is to update her W-4 with her employer and ask that they withhold an additional $400 each month from her paycheck. Or, alternatively, she could make quarterly estimated tax deposits of $1,200 each. Either way, over the year, she will have withheld an additional $4,800. That amount will then reduce the chances of her having a balance due on the next year's return. One small trick in avoiding penalties on income earned late in the year that I often recommend to clients is to make the adjustments on their W-4 rather than to adjust their estimated payments. For instance, imagine that your client performs a service for a neighbor in November, for which he earned a substantial income which will result in higher taxes. If he sends in a quarterly payment, he could be penalized because he didn't make payments the first 3 quarters. However, if he goes to his employer, assuming he has one, and stipulates on his W-4 that the employer increase the withholding amount to cover the additional taxes, there will be no additional penalty. Just remind the client that he will need to change his W-4 at the beginning of next year. What about backup withholding? Backup withholding is required when a taxpayer opens a savings account at a bank or provides a service for a company and refuses to provide a Social Security number. The payer is then required by the federal government to take backup withholding. Taxpayers could be exempt from withholding if they had no tax liability the previous year. For instance, many college students work part-time in the summer and earn a minimal amount off which they live. If that amount is less than the standard deduction, what happens? They don't owe any tax. So they can fill out their W-4 form and say they are exempt at the bottom so that no income tax will be withheld. Social Security and Medicare taxes will be deducted, but no federal withholding. If the taxpayer claims an exempt status, but his situation changes later, he should plan to file a new W-4 with his employer as soon as possible to begin the withholding process. So, if a student claimed exempt because he planned to go back to school in the fall, then changed his mind and decided to work the rest of the year, it's probably going to put him over the standard deduction, in which case he should resubmit his W-4 and remove himself from exempt status. He may also wish to increase his withholding to avoid owing taxes on the money made during the summer while exempt. Exempt status is good for only 1 year. The taxpayer must provide his employer with a new W-4 by February 15th of each year to continue being exempt. A taxpayer is also required to complete a new W-4 form with his employer within 10 days if he was claiming married status and then divorced, or if something else happened to decrease the number of withholding allowances the taxpayer was permitted to claim.